The Economist Intelligence Unit, EIU, has revised its global GDP growth forecast for 2024 to 2.5%, indicating steady growth compared to the previous year. Nigeria is expected to experience a growth rate of 2.5% in 2024, supported by higher crude oil output and a new mega refinery. However, the country's heavy reliance on hydrocarbons poses challenges. Meanwhile, Ghana may see a slowdown in GDP growth in 2023 due to rising prices and monetary tightening, but growth is expected to pick up later, driven by increased earnings from gold and oil exports. Both countries face unique economic factors that may impact their growth. Dr. Josh Bamfo, partner and head, Transfer Pricing Group, Anderson in Nigeria, joins me for this. Thank you so much for joining me, Doctor.
Thanks for having me, Petra.
All right, let's dive right in. Now, what specific factors beyond the U.S. economy contributed most to the EIU's upward revision of the global GDP growth forecast?
So the upward revision growth forecast were mainly driven by the perceived or expected performance of the advanced economies and some emerging economies. So clearly, U.S. was a major factor. Their growth rate was revised upwards from 2% to 2.2%. And being such a large economy, obviously that has a lot of weight and then pushes the projection upwards. Similar expectations have been formed for the Euro countries, which have struggled, in trying to deal with high inflation and therefore had to implement, tight monetary policies, which led to sluggish growth. However, the projections have been revised upwards from 0.8 to around 1%. So those are two major regional blocks with those upward revisions in terms of their performance that impacted the global, growth rate forecast. A similar expectation was formed for some of the emerging economies, such as Brazil, which is a large economy. And so Brazil's projection has been revised upwards from 1.8% to about 2.1%. So these are the major regional blocks that have seen revised upward projections being made for them, and therefore has had an impact on the global economy projection as a whole. And therefore, we have an upward projection from 2.4% to 2.5% from EIU.
All right. Now, while oil output is higher than expected, what do you make of the projection by EIU that Nigeria's heavy reliance on hydrocarbons might sort of pose some form of risk? What do you make of that?
So in Nigeria's case, it's a mixed bag because there are some factors that are working against Nigeria and other factors that makes EIU and other international financial institutions form the expectations that the economy might get better over time. So as you rightly are aware, with those two major market liberalization policies implemented by the current administration at the beginning of the administration in June, which is the liberalization or the removal of the fuel subsidies, as well as the floating of the exchange rate regime from a fixed exchange rate regime to a more flexible exchange regime, has had some adverse impact, especially on the inflation side of things, and as well as volatility of the exchange rate, which has had some adverse impact on the economy as a whole. But that said, EIU believes that towards the latter end of the year, some of these policies will start gaining traction. In the short term, they might be a bit shaky, but they might start gaining traction. For example, the liberalization of the foreign exchange market will find some stability, and that will enable businesses to be able to make proper plans and therefore bring more economic activities. And this, in the same vein, with the removal of the fuel subsidies, that puts less pressure on government in terms of funding of such subsidies. And that, by freeing those resources, they can then invest in capital projects such as infrastructure development, and those can then lead to, positive impacts in terms of the growth. Now, in terms of the heavy reliance on crude oil production, the good news is with the challenges that the global economy has faced with geopolitical conflicts such as the Ukraine-Russian war, the whole quickness to transition from crude oil to cleaner forms of energy has slowed down because most of these European countries are actually demanding some of these crude oils for energy purposes. So this is going to be a problem, but it's no longer immediate or even medium term. It's been pushed further down the line. So Nigeria has the opportunity to maximize its returns from the export of crude oil and at the same time has the luxury of time to transition to have a good mix of clean energy sources as well as the export of crude. So I don't see that to be a significant risk in the short to medium term, but something that you need to bear in mind because that transition period has been pushed further out due to some of the challenges that European countries are facing and because of geopolitical conflicts.
Okay, so based on what you said, I'm interested in the transition. Do you think Nigeria is ready for that transition? I mean, what are the steps that should be taken right now to prepare for that time? And how far is that time really? You've talked about how this particular time has been pushed back as a result of geopolitical tensions. Let me get your thoughts on this before we move on.
So I think it's, I think it's important that Nigeria takes it seriously because, when you look at it from, a few years back where US was championing a fast transition, to cleaner sources of energy, which was the main, policy thrust of the Joe Biden administration when they were campaigning to win elections. There was that pressure on a lot of IOCs to actually transition, and we saw a number of IOCs, divesting out of Nigeria. But now that has been pushed further out, and I think it's important that Nigeria starts thinking about the transition process, and I believe they're already doing that and making investments in those directions. So, I think it's a good problem to have. It brings about more diversification and not over-dependence on just crude oil exports. So, my view is that it's a good problem to have. It's going to help with some diversification, make us think outside the box in terms of other sources of energy that are cleaner and better for the environment.
That's quite interesting. You talked about Nigeria, getting set and being on that track, talking about even what was launched by the former vice president, to aid the transition and all of that. But what do you make of a situation where we know that the future is gas, the future is cleaner energy, and then Nigeria decides to impose tax of up to 30% on gas and all of that? What do you think will happen to people who want to invest in that sector? Isn't that sort of taking us back?
Yeah, I think so too. And so I think part of the pivot, they actually have to pivot away from overdependence on crude oil. And part of the pivot should be the fact that you need to create some incentive for investments in areas that are seen as much cleaner in terms of source of energy compared to hydrocarbons such as crude. So I believe that, with the kind of policies that we have, in the Petroleum Act of Bill, all these policies will be implemented and will help us with the transition. The good news is time is on the side of the government, and so policies can be implemented to help with that transition away from overdependence on hydrocarbons.
All right, so beyond rising prices and monetary tightening, let's go to Ghana now. We've talked about Nigeria for a while. So beyond rising prices and monetary tightening, are there any other factors that sort of contribute or contributed to Ghana's projected GDP slowdown?
So Ghana's current GDP slowdown, which can be seen by looking at the 2023 numbers. So 2023 GDP growth rate numbers are out. Ghana grew by 2.9%. Prior to that, Ghana had grown around 3.38 thereabout. For 2022, 2021 was about 5%, even though there was a base effect, because in 2020, during the COVID-19 period, GDP growth was non-existent. It was around 0.5%. So clearly, there's been some contraction, and there's been a number of reasons for that. But to put it in proper perspective, you need to look at pre-COVID-19 and period performance. The GDP growth rate actually grew at an average of 7% from 2017 to 2019. In fact, 2017, the growth rate was about 8%. So that tells you that a number of factors have come to play. Some of the immediate factors has been the high inflation that Ghana actually witnessed, in part due to higher energy prices, high volatility of the exchange rate, and obviously geopolitical tensions across board also feeding into high inflation, which forced the Central Bank of Ghana, which is the BOG, Bank of Ghana, to implement tight monetary policies, increasing interest rates, and therefore making cost of borrowing more expensive, which then led to a reduction in total production of goods and services, hence leading to a low GDP growth rate. But even prior to that, if you go back to 2021, 2022, Ghana had serious debt challenges. Our debt to GDP ratio prior to COVID-19 hovered around 59% to 61%. By COVID-19, that has jumped almost around 80%. and went as high as 95% at some point, leading to independent credit rating agencies downgrading the sovereign credit rating of Ghana, which meant Ghana couldn't access the international capital markets and therefore couldn't actually make, fund some of its outstanding debt, especially those in USD. Hence, having to go to IMF, for some support. That meant that they need to meet some conditionalities, which was very challenging. So now Ghana finds itself, turning the corner because inflation went as high as 37% as of last year, and today it's hovering around 25%. So the good news is inflation is going down. They have access to IMF $3 billion funds, and they have access to other funds coming in that they can actually invest in capital projects that stalled because of their debt restructuring, and therefore can stimulate the economy down the line. So 2024 is going to be a bit exciting. It's an election year towards December. Projects have recommenced, such as road constructions, bridges, and so on. So we are yet to see how 2024 will actually pan out. But 2023 was a tough year for Ghana.
All right, so talking about Ghana, really, there are three things I would have loved us to talk about, whether it's the election and its impact, or to talk about the debt restructuring, or even the role the IMF's $3 billion, will sort of play in ensuring stability in Ghana's economy in the nearest future. Let me see if you can wrap all of that up in 30 seconds.
Yeah, so all those are very important. So the role of the access to the funds and gives investors some confidence that the economy is on the right track and wouldn't collapse, right? So that was a very important bailout that came from IMF, building investor confidence in the country again. Two, the election is going to be very critical. It's in December, which means that economic activities are likely to actually be on an uptick, and hopefully that can translate to GDP growth rate. The fear will be, the level of spending. How does it impact inflation if there's excess spending in the economy and there's no commensurate production to meet those excess spending? And the other aspect will be whether we are going to have huge deficits, which then adds to the debt and worsens the debt crisis. But if we're able to manage the spending side of things and economic activities actually do go up, then it's a good thing for the economy. So those are some of the issues that I think are very important. I've forgotten the third point that you asked, but those were the two issues that still comes to mind.
All right, thank you so much, Dr. Josh Bamfo, partner and head, Transfer Pricing Group, Anderson. Thank you so much for your time on the show today.
Thanks for having me.